Hello and a very warm welcome to Trust TV, a show designed to give you unequivocal access to the mind of a professional investor and the thinking that drives their decision making. I'm your host, Marcus De Silva. First audience question for you here. Is there greater potential for income from FTSE 250 companies than from FTSE 100?
I suppose, what do you mean by income? If it's income yield or income growth? You know, we seek to try and generate both, because actually income, I think some people think income investors, you know, we're just after the dividend yield, but it's not just about the dividend yield, it's just about the dividend growth. You know, can a company sustain a dividend and can it grow it into the longer term? These are important questions we need to ask our companies. I think you find in the FTSE 250 you get smaller companies which are probably higher growth, so actually we're probably expecting more dividend growth from those types of companies. But let's not ignore the FTSE 100. There are some good companies that pay very attractive dividend yields that also you should combine with the 250 names within a blended portfolio.
How big a problem do UK FTSE income payers face in having sustainable dividend coverage? Are they paying out too high a ratio of earnings to be sustainable?
I think it depends on a stock by stock basis. Hence why it's vitally important that we do our stock analysis. We've got to make sure that a company has enough cash flow to pay that dividend, but also we've got to make sure they've got enough cash flow to invest in their businesses, so that cash flow and that dividend is sustainable into the longer term. I think when you look at a lot of concerns when people look at the top 20 income payers of the FTSE 100 is they do have very high yields which aren't very well covered. Again, it comes back to stock picking, making sure we pick the ones that are able to pay those dividends into the longer term. So it is a key concern, but it's coming back to the stock analysis that you do on each individual company.
How do you keep volatility low in the portfolio? Presumably bonds play a part in this.
Yeah, I mean that's certainly one aspect of it. Having the ability to have bonds does typically lower the overall volatility of the trust. Another way is obviously having that diversification within the equity portfolio. Typically as income fund managers, looking for the companies I do, they will be typically, good quality, long-term, companies you own for the longer term, and they will typically have lower volatility than say the market as overall case. So you would expect us to own more mature businesses, not those, high growth but quite volatile, smaller cap companies. It's about, having that blend, but overall we'll probably have a lower volatile portfolio than the market.
Looking at the FTSE 100, there is a concern amongst some investors that the top companies are really paying out a large portion of those dividends. It's very concentrated, the income in the FTSE 100. Is that a concern for you? How do you get around this?
I think it is a concern. I did some analysis on the trust and looked back in terms of 1989 and how the market looked like in terms of income back then, and actually the top 20 companies contributed about 50% of the market's income. You roll forward to today and actually that's more like 72%. So it is quite a concern if you own those 20 companies and if you think the dividends are unsustainable. I think the ways you get around that is actually having our unique structure of being able to own bonds. That's helpful. Diversifying where we get our income from is good. I think again, just because the market's concentrated, you can't have a well-diversified portfolio within the equity portfolio. So one of our rules is to make sure that each company doesn't contribute more than 5% of the trust's income. Also, being a relatively small trust, going into the mid-cap area of the market, we don't have to own those top 20 companies. We can look elsewhere for our income. Going overseas, again, a good way of generating income elsewhere. And then finally, being an investment trust, so having those revenue reserves. If we do go into more difficult times for income across the wider market, not just those highly, high dividend yielders in the FTSE 100, having those revenue reserves, sets you up in a good place if that outlet for income becomes more difficult.
And that's all we have time for today. Thank you very much to David. I'd like to thank the audience as well for all of your great questions. We hope you found some useful insight in today's discussion. Until next time, goodbye.